created by MyGuide. What is options trading compared to stocks trading? The most important aspect of an option is that, as its name suggests, the buyer of the option has the right to exercise the contract, but is under no obligation to do so. Therefore, the option buyer will only exercise the option when it's smart to do so. Options give you leverage in your investing. An options contract can give you cheaper exposure to a stock than buying shares outright, magnifying both profits and losses if the stock price moves. Options can offer a source of portfolio income. By selling options rather than buying them, you're the one to receive the payment for the option in finance. An option is a contract which gives the buyer the right, but not the obligation, to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. The strike price may be set by reference to the spot price of the underlying security or commodity on the day an option is taken out, or it may be fixed at a discount or at a premium. The seller has the corresponding obligation to fulfill the transaction to sell or buy if the buyer exercises the option. An option that conveys to the owner the right to buy at a specific price is referred to as a call. An option that conveys the right of the owner to sell at a specific price is referred to as a put. Both are commonly traded, but the call option is more frequently discussed. The seller may grant an option to a buyer as part of another transaction, such as a share issue or as part of an employee incentive scheme. Otherwise, a buyer would pay a premium to the seller for the option. A call option would normally be exercised only when the strike price is below the market value of the underlying asset, while a put option would normally be exercised only when the strike price is above the market value. When an option is exercised, the cost to the buyer of the asset acquired is the strike price plus the premium, if any. When the option expiration date passes without the option being exercised, the option expires and the buyer would forfeit the premium to the seller. In any case, the premium is income to the seller, and normally a capital loss to the buyer. The owner of an option may on-sell the option to a third party in a secondary market, in either an over-the-counter transaction or on an options exchange, depending on the option. The market price of an American-style option normally closely follows that of the underlying stock, being the difference between the market price of the stock and the strike price of the option. The actual market price of the option may vary depending on a number of factors, such as a significant option holder may need to sell the option as the expiry date is approaching and does not have the financial resources to exercise the option. Or a buyer in the market is trying to amass a large option holding. The ownership of an option does not generally entitle the holder to any rights associated with the underlying asset, such as voting rights or any income from the underlying asset, such as a dividend. Contracts similar to options have been used since ancient times. The first reputed option buyer was the ancient Greek mathematician and philosopher Thales of Miletus. On a certain occasion, it was predicted that the season's olive harvest would be larger than usual, and during the off-season, he acquired the right to use a number of olive presses the following spring. When spring came and the olive harvest was larger than expected, he exercised his options and then rented the presses out at a much higher price than he paid for his option. Options can also reduce risk in your overall portfolio. For instance, you can combine buying a put option to sell stock at a specified price with ownership of the shares themselves. That trade, known as a protective put, gives you the upside if the stock price rises, but protects you from a portion of the losses if the stock price falls. Contract specifications. A financial option is a contract between two counterparties with the terms of the option specified in a term sheet. Option contracts may be quite complicated, however, at minimum, they usually contain the following specifications. Whether the option holder has the right to buy or the right to sell. The quantity and class of the underlying asset. The strike price, also known as the exercise price, which is the price at which the underlying transaction will occur upon exercise. The expiration date, or expiry, which is the last date the option can be exercised. The settlement terms, for instance, whether the writer must deliver the actual asset on exercise, or may simply tender the equivalent cash amount. The terms by which the option is quoted in the market to convert the quoted price into the actual premium, the total amount paid by the holder to the writer. Thank you for watching this video. Convert any text or PowerPoint to video using MyGuide for free. Just Google MyGuide.